Chapter 2. Types of financing. Introduction. Every business enterprise requires funds for the purpose of 1. Implementation of a new project. 2. Expansion of existing project. 3. Diversification to a new project. 4. Modernization scheme. 5. Working capital. There are several sources of funds available in the market, and effective appraisal mechanism is required to be instituted to achieve its object of maximization of profit, with minimum possible risk. Selection of sources of finance will depend upon 1. Risk involved. 2. Tenure. 3. Cost of funds. Requirement of funds. 1. Long-term needs. Purpose. Investment in fixed assets, permanent or core working capital. Time span. 5 to 10 year. Type of fund. Owners funds. 1. Equity share capital. 2. Preference share capital. 3. Retained earnings, plowback of profits. 4. Capital subsidy, incentives. Borrowed funds. 1. Debentures, bonds. 2. Term loans from institution, rupee loan, foreign currency loan. 3. Term loans from banks. 4. Venture capital financing. 5. Interest-free sales tax loan. 6. Asset, debt securitization. 7. Euro equity issues. 8. New debt instruments. 9. Certificate of deposit. 2. Medium-term financial needs. Purpose. Extensive publicity and advertisement campaign, to meet the cost, the benefit of which is expected over 1 to 5 years. Time span. 1 to 5 years. Type of fund. Owners funds. Preference share capital. Borrowed funds. 1. Debentures, bonds. 2. Public deposits. 3. Loans from financial institutions. 4. Loan from commercial banks. 5. Lease financing. 6. Hire purchase, installment financing scheme. 7. Euro debt issue. 8. New debt instruments. 3. Short-term financial needs. Purpose, to financial fluctuating working capital requirement, to execute export orders. Bridge finance, pending formalities of term loan. Sanctions. Time span, not exceeding a period of 1 year. Type of fund. Borrowed funds. Term 1. Credit, from trade and expense creditors. I. Trade credits. E. Advances from customers. E. Short-term provisions. 2. Bank advances. 3. Factoring. 4. Commercial papers. 5. Public deposits. 6. Intercorporate deposits. 7. Short-term unsecured debentures. 8. Bridge finance. Source of finance, primarily source of finance can be divided into 2 parts. 1. Owner's capital or shareholders' funds. 2. Borrowed capital. Equity share capital. 1. Private limited company raises funds. Promoters, their relatives and friends. 2. Public limited company raises funds from promoters as well as from public. 3. Permanent source of funds. 4. Equity shareholders, being owners of company, undertake the risks of business. 5. Right to elect board of directors and have the control over the management of company. 6. Redeemed only in case of liquidation, hence least risk involved. Exceptions. I. Buyback of shares. E. Redemption of excess capital. 7. Shareholders are entitled for dividend, which depends upon I. Profitability position. E. Liquidity position. E. Financial needs of company. There is no mandatory payment of dividend to equity shareholders. 8. Dividend, being an appropriation of profit, is not deductible while computing taxable profits of business. 9. Costliest but less risky capital, in the capital employed of the company. 10. Equity capital provides security to lenders of fund. 11. The company can make further issue of share capital by making a right issue. 12. The company can issue bonus shares by way of capitalization of reserves. Merit and demerit. Merit, equity capital. Provides security to lenders of fund. No need to create any charge against the assets of the company. The company can use the funds flexibly. Demerit, costliest source of finance. Dividend being an appropriation of profit is not deductible. Further issue of share capital dilutes the ownership. Further issue of shares may reduce the EPS preference. Share capital. 1. Preference share is a hybrid security because it has features of both ordinary shares and bonds. 2. The holders of such shares enjoy priority both as regards to fixed dividend and redemption in case of winding up. 3. Different types of preference share, viz. A. Cumulative and non-cumulative preference shares. In cumulative preference shares, unpaid dividend gets accumulated. All arrears of dividend must be paid before any dividend can be paid to equity shareholders. The non-cumulative preference shares carry a right to fixed dividend out of profits for that year only. In case of non-availability of profits, the holders of non-cumulative preference shares are not entitled to arrears of dividend. B. Participating and non-participating preference shares. Participating preference shares carry a right to participate in surplus profits, along with equity shareholders after dividend at a certain rate has been paid to equity shareholders, in addition to entitlement of fixed dividend. Again, in case of wind-up, if there remains surplus after paying both the preference and equity shareholders, then the holders get additional share in the surplus assets. The right to participate is given in the memorandum or articles or by virtue of terms of issue. C. Convertible and non-convertible. Convertible preference shares can be converted into equity shares during a specified time period, at a specified price and in a specified ratio. D. Cumulative convertible preference shares, CCPs, may also be offered, under which the shares would carry a cumulative dividend and specifies a limit for a period of say 3 years, after which the shares are converted into equity shares. 4. A public company may issue redeemable preference shares to be redeemed after a fixed period. 5. A medium or long-term source of funds. 6. Preference shares enable the company to avoid dilution of equity capital. 7. There are no voting rights offered to preference shareholders. 8. Preference dividend, being an appropriation of profits, is not tax deductible. 9. Though company creates financial leverage, as there is a fixed dividend, cost of preference share capital is far greater than cost of debentures, borrowed funds. 10. If debt-equity ratio is high or cost of equity financing is relatively high, the case for using preference shares will be strengthened. 11. For normal preference shares, the maximum permissible rate of dividend is 14% merit and demerit. Merit preference capital provides security to lenders of fund as they form part of net worth. They carry a fixed rate of dividend which gives advantage of financial leverage. There are no voting rights offered to preference shareholders. Payment of dividend is only out of profits. The company can use the funds flexibly. No need to create any charge against the assets of the company. Demerit, costlier than debentures or loans. Dividend being an appropriation of profit is not deductible. The holders of such shares get priority both as regards to fixed dividend and redemption in case of winding up as compared to the equity shareholders. If preference dividend is not paid on time, it might affect the market image of the firm and give voting rights to those shareholders. As redemption is obligatory, it involves a huge amount of cash outflows on redemption. Retained earnings, plowback of profits. 1. A company may plow back profits earned. Accumulated retained profits are reserves and is a part of equity or net worth. 2. They belong to equity shareholders. Increase in net worth strengthen the shareholders' equity base and service as promoters' contribution, if represented by liquid funds. It increases debt borrowing capacity of a company. 3. By virtue of legal provisions, company must plow back reasonable amount of profits every year to meet long-term requirement. 4. Such funds entail no risk. 5. Further, there is no dilution of control of the present management group. 6. A company by complying legal requirements can pay dividend out of accumulated profits or retained earnings. 7. It is one of the most preferred sources of finance. Debentures or bonds. It is acknowledgement of debt, given under the seal of the company and containing a contract for the repayment of principal sum at a specified date and for the payment of interest at fixed rate until the repayment of principal sum, and it may or may not give the charge on the assets of the company as security. 1. Debenture holders are the creditors of the company and hence no voting rights are enjoyed by them. 2. Debentures are redeemable according to the terms of their issue. 3. Interest on debentures must be paid irrespective of profitability of the company. It is a charge against profits. 4. In case of liquidation, debenture holders being creditors have prior claim over the shareholders. 5. Raising funds by way of debentures has advantage of financial leverage or trading on equity. 6. Interest on debentures is tax deductible. Thus, there is a tax shield and a source of finance becomes cheaper. 7. Debentures are usually secured on the assets of the company, and therefore carry lesser risk and assured return to the investors. 8. As it is obligatory to pay interest at regular intervals and repayment of principal sum on scheduled dates. Any failure in obligations may paralyze the company's operations. 9. Financing through debentures is associated with financial risk to the company. This increases the cost of equity capital. 10. Higher risks bring higher capitalization rates on equity earnings. Thus, even though gearing is favorable and raises EPS, the higher capitalization rate attributable to gearing may drive down the market price of equity shares. 11. There is a flexibility in debentures funds. Surplus funds with the company may be utilized for buying own debentures from the market and making cancellation thereof even before maturity date. 12. A company may issue convertible debentures, CDs, in which option may or may not be given to debenture holders to convert them into equity or preference shares at stated issue price, after a certain period. CDs may be fully or partly convertible. 13. In a period of rising prices, debentures issue is advantageous. The fixed monetary outgo decreases in real terms as the price level increases. 14. Public issue of debentures and private placement to mutual funds now require that the issue be rated by credit rating agency like CRISIL, Credit Rating and Information Services of India Limited. Credit rating is given after evaluating factors like track record of the company, profitability, debt service coverage, creditworthiness and perceived risk of lending. 15. For all debentures having a maturity period beyond 18 months, a debenture redemption reserve, DRR, is created by transferring at least 50% of the redemption amount to this reserve out of the profits of the company before the redemption date. 16. Debentures are classified into, from security point of view, secured debentures, unsecured debentures. From registration point of view, registered debentures, bearer debentures. From priority point of view, first debentures, second debentures etc. From enlisting point of view, listed debentures, unlisted debentures. From conversion point of view, convertible debentures, non-convertible debentures. From redemption point of view, redeemable debentures, irredeemable debentures. Merits of debenture as a source, raising funds by way of debentures has advantage of financial leverage. Interest on debentures is tax deductible. No voting rights are enjoyed by debenture holders, no dilution of control. Fixed amount of interest also provides a protection against unanticipated inflation. Demerits of debenture as a source. Interest on debentures must be paid irrespective of profitability. Debenture holders being creditors have prior claim over the shareholders at the time of liquidation. Debentures are usually secured on the assets of the company. Financing through debentures is associated with financial risk to the company. Debenture trust deed may impose restrictions on the company and reduce its flexibility. Term loan from financial institutions. The following financial institutions cater major part of financial needs of the Industrial I. Industrial Development Bank of India, IDBI, E. Industrial Finance Corporation of India, IFCI, E. State Finance Corporation of India, SFCI, IV. State Industrial Development Corporations, SIDCs, V. Industrial Reconstruction Bank of India, IRBI, VI. Small Industries Development Bank of India, SIDBI, VII. Life Insurance Corporation of India, LIC, VII. Unit Trust of India, UTI, IX. General Insurance Corporation, GIC, and its subsidiaries. X. Shipping Credit and Investment Company of India Limited, SCICI. Before term loan is sanctioned, a company must satisfy the financial institution regarding technical, commercial, economic, financial and managerial liability of the project. Such loans are available at different rates under different schemes. A lending institution stipulates number of conditions regarding the managerial and other financial policies of the company. The important covenant of the loan agreement includes amount of loan, rate of interest, additional levy interest, commitment charges, reimbursement of costs etc., last date of withdrawal, repayment schedule, conversion right, security for the loans, appointment of nominee directors, restriction on payment of dividends, permission to carry out expansion on diversification, inspection of books and property, commitment to investment of funds, consent for change in scheme, appointment of managing director, changes in memorandum and articles of association with prior approval affecting institutional interest, raising unsecured loans, raising of financial resources, submission of physical and financial progress reports, review of project cost, withhold disbursement in certain cases, information about change in important contacts, maintenance of property, merger compromise with institutional consent, material happenings to be informed, creation of subsidiary with prior permission, promoter's contribution towards the project, lock-in period for promoter's funds, etc. Salient features: 1. Term loans are secured borrowing and is a long-term source of finance for new projects. 2. Rate of interest depends upon credit rating of the borrower, perceived risk of lending and cost of funds to the lender. 3. Term loan is generally repayable over a period of 5 to 10 years in quarterly, half-yearly installments. 4. For large-scale projects, all India financial institutions provide finance usually under consortium arrangement. 5. Interest on term loan is tax deductible. 6. Foreign currency loan carries a risk of exchange rate fluctuations. 7. Administrative cost of serving the loan is minimal as compared to cost related to debenture, bond option. 8. Financial institutions keep a clause reserving the right to convert the loan into equity shares of borrower company, subject to certain conditions. 9. Financial institution has a right to appoint nominee director on the board of the borrower company, who will not be liable to retire by rotation or removal. Term loan from banks. The primary role of the commercial bank is to cater to short-term requirement of late, however banks have started term financing of industries, though the formal term loan lending is so far small and confined to major banks only. Salient features. 1. Term loans are secured borrowing is medium, long-term source of finance for additions to fixed assets. 2. Rate of interest depends upon credit rating of the borrower, perceived risk of lending, and cost of funds to the lender. 3. Term loan is generally repayable over a period of 4 to 7 years in quarterly, half-yearly installments. 4. Interest on term loan is tax deductible. 5. Administrative cost of serving the loan is minimal as compared to cost related to debenture, bond option. Venture capital financing. When technically competent entrepreneurs, who lack experience and funds required as promoters' contribution is financed under venture capital financing. Venture capital financing refers to financing new highly risky venture promoted by qualified entrepreneurs with a potential of success. Venture capital industry is a recent introduction. It is a national priority especially in the areas of telecommunication, non-conventional energy, quality upgrading, biotechnology, information technology, induction of new technologies, etc. The Government of India issued guidelines for venture capital companies in 1988 and offered number of tax concessions. In 1999 the existing guidelines are relaxed to increase the attractiveness of the venture schemes and induce high net worth investors to commit their funds to sunrise sectors, particularly the information technology sector. Initially the contribution to the funds available for the venture was only from all India financial institutions, state development corporations, commercial banks and companies in private sector. In the last couple of years, many offshore funds have been started in the country and maximum contribution is from foreign institutional investors. Some methods of venture capital financing are as follows. 1. Equity financing. As venture capital undertaking generally requires funds for a longer period but may not be able to provide returns to the investors during initial stages. The venture finance is normally the form of equity capital. The equity contribution of venture capital funds does not exceed 49% of the total equity capital, so that control remains with the entrepreneur. 2. Conditional loan. Loan is repayable in the form of royalty after the venture enterprise can generate sales. No interest is payable on such loans. A royalty charge may range between 2 to 15%. Actual rate depends on factors like gestation period, cash flow pattern, risk and other related factors. Some capital finances give a choice to enterprise of paying high rate of interest, say above 20%, instead of royalty on sales once it becomes commercially sound. 3. Income note. It is a hybrid security which combines the features of both conventional loan and conditional loan. The entrepreneur has to pay both interest on loan and royalty on sales, but at substantially low rates. 4. Participating debentures. Such security carries charges in 3 phases. Start phase. No interest. Next phase. Low rate of interest up to a level of operation. Subsequent phase. High rate of interest. Factors that a venture capitalist should consider before financing any risky project. Level of expertise of company's management. The success of any new project is highly dependent on the quality of management team. Level of expertise in production. The entrepreneur should have necessary technical ability to be able to develop the new product and service. Nature of new product, service. The venture capitalist should consider whether the development of new product, service is technically feasible. Market. The venture capitalist should seek assurance that there is actually a market for the new product. Risk. Borne by the entrepreneur. The venture capitalist should see that the risk borne by the entrepreneur is high. This will ensure that the entrepreneur will have sufficient level of commitment to project. Capital subsidy, incentives. Order to encourage the dispersal of industries in the less developed areas, government has been giving a package of incentives to new expansion units set up in the developing region. The package scheme of incentives introduced in 1964 were amended from time to time, e.g. Government of Maharashtra has introduced a new scheme viz. Package Scheme of Incentives 2001 for accelerating the process of dispersal of industries to the less developed regions and promoting high-tech industries in developed areas of the state, coupled with the object of generating mass employment opportunities. The following categories of industrial and other units will be considered for incentives. 1. Industries listed in the first schedule of Industrial Development and Regulation Act, 1951. 2. Small-scale industries, coir, silk, handicraft, and khadi industries. 3. Information technology. 4. Hotels. 5. Poultry and agro-industries. 6. Biotechnology. 7. Non-conventional energy. The quantum of incentive varies with reference to developed areas. No incentives are allowed to units located in developed area, but maximum benefits are extended to units located in backward areas. The incentives may be in the form of 1. Special capital incentives as a grant computed based on certain % of fixed capital investment, with a ceiling. 2. Interest subsidy. 3. Refund of octroi, entry tax. 4. Exemption of electricity duty. 5. Exemption of sales tax or deferment of sales tax. The capital incentives form a part of long-term finance. However, one must not be dependent on the availability of incentives for economic viability of the project. The incentives are sanctioned and released to the units only after they have complied initial effective steps and final effective steps respectively. The release of incentives by the concerned state government generally take 1 to 3 years. The promoters therefore find it convenient to avail bridge finance against the sanctioned capital incentives. However, bridge finance is normally made available to the extent of 85% of the sanctioned incentives. Interest-free sales tax loan state government as a package of incentives. Sanction interest-free sales tax loan either by way of deferment of sales tax liability of a new unit or disbursing sales tax loan based on sales tax paid by existing unit in the past. The loan is repayable after the 10th of December 14 years. Thus, it serves as a long-term loan without any interest. Asset. Debt securitization. Securitization refers to both switching away from bank intermediation to direct financing via capital market and/or money market. Securitization is a process of transformation of illiquid assets into security, which may be traded later in the open market. Method of recycling of funds. It is especially beneficial to financial intermediaries to support lending volumes. Assets generating steady cash flow are packaged together, and against this asset pool, market securities can be issued. Securitization process. 1. The originating function. A borrower seeks a loan from finance company, housing company or lease from leasing company. The creditworthiness of the borrower is evaluated, and contract is entered in a normal manner with repayment schedule. 2. The pooling function. The originated assets viz. Trade, receivable, lease rentals, housing loans, automobiles etc. according to maturity pattern and interest rate risk are clubbed together to create a pool. This pool is transferred, in favor of Special Purpose Vehicle, SPV, which acts as a trustee for the investor. Once the assets are transferred, they are held in the SPV's portfolio. 3. The securitization function. It is the SPV's job now to structure and issue the securities based on asset pool. The securities carry a coupon and on expected maturity which can be asset-based or mortgage-based. They are generally sold to investors through merchant banker. The investors interested in this type of securities are generally institutional investors like mutual fund, insurance companies etc. The originator usually keeps spread available between yield from secured assets and interest paid to investors. Thus, trustees act as receiving and paying agent. Thus, good quality loans will be eligible for securitization. The repayment pattern of assets will be deciding factor to structure the instrument. Instruments in securitization. Major instruments issued under the securitization are the pass-through and the pay-through securities. Salient features of these securities are given below. 1. Pass-through securities, certificates, PTC, instrument, as its name indicates, passes all the cash flows generated from the portfolio are passed on to the investors without any intervention. In other sense, cash flows from the original portfolio are passed on to their investors, whenever they ask. It results in the huge prepayment risk to the investors. It essentially means that if the prepayment takes place on a 10-year pass-through instrument, its life may shrink to even 1 day. 2. Pay-through securities. Pay-through securities differ from the pass through as the investors are given cash flows at the predetermined time irrespective of the cash flows from the original portfolio in the deal. We can say that the prepayment risk in the instrument is absorbed by the SPV. What happens practically in the deal is that the SPV maintains the prepaid cash flows at its end and pay to the final investors at the predetermined time. Only these instruments appeal to the wide range of investors because of the different maturities, risk and return profiles, status and role of special purpose vehicle or special purpose entity, SPV, or SPE. It would be evident from the above discussion that the SPV plays a very crucial role in the whole deal. It is the transforming device. It essentially is the means to convert one form of asset into another form. Salient features of the SPV may be mentioned as follows. It is a vehicle to transform assets into securities. It is a transformation device, specially created to hold the assets in trust for the investors. As per the securitization bill recently cleared by the government, SPV may take the form or trust or company, securitization company. In case of securitization trusts, structure of SPV would be exactly like the mutual funds. As mentioned above, real financial engineering takes place at the SPV's end and in the whole securitization process. It plays a very crucial role. Types of securitization. 1. Securitization with recourse. With recourse is a legal term and relates to the credit risk retention by the originator. It essentially means that the assets are sold to the investors through SPV with the clause that if any party in the portfolio of assets defaults, it would be protected by the originator, i.e. the originator would make the default good. 2. Securitization without recourse. In case of securitization without recourse, whole risk in the asset portfolio is transferred to the investors through the SPV, i.e. originator is in no way concerned with the assets once that is sold to the SPV. This is the true form of securitization. B. In this case, simply the asset would get converted into cash for the originator with no future obligation. So, this transaction is performing two functions, one the financing and another the credit risk transfer to the investors from the originator. C. The issuer is under an obligation to pay to the investors only if the cash flows are received by him from the collateral. D. The risk run by the investor can be further reduced by obtaining insurance cover, often provided by a pool insurance policy. What can be securitized? Any future cash flow can be securitized in the market. So, we may say that the prominent assets for the securitization are as follows: physical assets, financial assets, operational assets. Any other receivable to be put to the perspective, there is no limit to the imagination and creativity, and from that angle there is huge room for the innovation in the market. Real path breaking deals are taking place in the market. To apprise you, in 1997 Mr. David Bowie, a rock singer, securitized the royalty from his albums and collected cool $58 million from the market. These bonds are called the Bowie bonds. Recently, in France and Belgium, some retailers have securitized their inventories of the champagne through bonds titled champagne bonds. Benefits to the originator. 1. The additional source of capital can be tapped through securitization, reliving trade receivables, deposit collection process. 2. Without disturbing the liabilities side of the balance sheet, the funds can be raised and enhance activity of lending, which increases the Profitability. 3. Reduce the existing debtors and its related risks. 4. Conversion of illiquid asset into liquid portfolio. 5. The assets are shifted off the balance sheet, thus giving the originator recourse to off-balance sheet funding. 6. It facilitates better balance sheet management, as assets are transferred off balance sheet, facilitating satisfaction of capital adequacy norm. 7. Enhancement of credit rating. 8. Improvement of income to asset ratio. Benefits to the investor. 1. He gets security which is backed by adequate collateral and has credit enhancement. 2. Securities are rated by credit rating agencies. It becomes easier for an investor to compare the risk-return profile of asset-backed securities with other investable instruments and make an informed choice. 3. It opens up new investment avenue. Factors required for success of securitization process. High quality assets with low default rate is essential. Standardized loan documentation. Stable interest rate structure. Well-developed capital market. Investors' awareness. Strong regulation. Difference between factoring versus securitization. Factoring. One range of investors. In factoring, only one party is involved. 2. Issue expenses. No issue expenses are involved in factoring. 3. Recourse. Factoring may be with or without recourse. 4. Receipt of payment. In advance factoring, factor gives an advance, say 90%, at the time of transaction and provides the balance at the time of settlement. 5. Additional services. Factors provides financial services and other services like follow-up with debtors, sales, ledger maintenance, collection, credit investigation, etc. 6. Time period. Short-term receivables are factored. 7. Credit rating. Credit rating is not compulsory. 8. Nature of receivables. Only existing receivables can be factored. Securitization. One range of investors. Issue of securitization are sold through a wide range of investors. 2. Issue expenses. Issue expenses are involved. 3. Recourse. Securitization is generally without recourse. 4. Receipt of payment. In securitization, cash is generally received as soon as the issue is placed. 5. Additional services. Securitization does not carry any such services with it. 6. Time period. Long-term receivables and short-term receivables can be securitized. 7. Credit rating. Credit rating is compulsory. 8. Nature of receivables. Future and existing receivables can be securitized. Public deposits. A source of short-term or medium-term finance. This had become important source of finance during the period of credit squeeze by RBI. B. A company can accept public deposits, subject to stipulations, up to a maximum of 35% of its paid-up capital and reserves from the public and shareholders. C. These are unsecured deposits and may be accepted for a period ranging 6 months to 3 years. D. As the deposits are available for a period of not more than 3 years, they are used for financing working capital requirements. E. The public deposits are renewable on maturity. Credit from trade and expense creditors. This represent credit granted by supplies of goods or expense creditors as a term of contract. Usually trade creditors grant a credit varying between 15 to 90 days. It generates automatically in the course of business and is common to all business operations. It may be in the form of open account or Bills payable. It is without any explicit cost. Keep on rotating is a source of finance for the gross working capital. Expense creditor period may vary according to the terms and conditions of contract, e.g. salaries and wages are payable monthly. But a bonus is payable annually or royalty may be payable on quarterly basis. This type of credit has also no explicit cost and keeps on rotating on a going concern. A manufacturer or contractor engaged in producing or constructing costly goods involving length of time usually demand advance from customers at time of accepting order for execution. Similarly, monopolistic organizations may demand advance from customers before the order is accepted. This source of finance has no explicit cost of capital. Bank advances. Bank advances are in the form of 1. Overdraft. Customer can withdraw in excess of his balance in current account up to a fixed limit. Though overdraft is repayable on demand, it generally continues for long period by annual renewals. Interest on this facility is charged based on daily products, and usually the rate of interest is higher than other short-term finance. The security for overdraft account may be by way of shares, debentures, government securities, fixed deposits, etc. Bank also allows clean overdraft to customers who are financially sound and reputed for their integrity. In case of clean overdraft, banks usually rely upon personal security of the borrower. A clean overdraft is generally granted for a short period only. 2. Cash credit. A limit is sanctioned by bank and the borrower can withdraw required funds at any time within that limit. The withdrawable amount may be fixed based on drawing power, which is calculated at a certain prefixed percentage of inventory, receivables. The interest is charged on daily product basis. Cash credit is usually secured against hypothecation of inventory and security of book debts. Though this is short-term finance used for working capital purpose, the facility continues for a longer period on its annual renewals. The borrower sometimes provides the security of goods by way of pledge. In this case, the borrower delivers the goods from pledged go-down only on depositing the borrowed amount with the bank. Similarly, on pledge of additional goods, the borrower can withdraw additional funds. 3. Bill discounting. Short-term capital by discounting the bill of exchange drawn on customers out of working capital total limit. Bill discounting limit also may be fixed by bank. The discount depends upon the amount of the bill, the maturity period, and the prevailing rate of interest. One of the shortcomings of the bill discounting system is that the bank which discount the bill must establish and verify creditworthiness of the buyer, which at times may be difficult, complicated and time-consuming process. 4. Letter of credit. Guarantee provided by the buyer's banker to the seller in case of failure or default of the buyer. Letter of credit issued by bank thus serves the purpose as security to the seller. The LC provides a non-fund-based financing as the funds are not involved in the issue of LC. It is a contingent liability of the bank and shall arise only if buyer fails to pay. Whenever LC is issued, the amount is adjusted against the fund-based cash credit limit of the buyer. It is an indirect form of financing. 5. Pre-shipment packing credit finance. Advance extended by banks to an exporter for the purpose of buying, manufacturing or processing, packing and shipping the goods to overseas buyers. An exporter having in hand firm order placed with him by a foreign buyer or irrecoverable letter of credit opened in his favor, can approach bank for availing packing credit. An advance taken is required to be liquidated within 180 days from the date of its commencement, by negotiation of export bills or receipt of export proceeds in an approved manner. Packing credit, in the case of customers of long standing, may also be allowed against firm contracts entered by them with overseas buyers. Types of packing credit. I. Clean packing credit. It is a Dean type of export advance. Each proposal is weighed according to requirement of trade and creditworthiness of the exporter. Export Credit Guarantee Corporation, ECGC, cover is obtained by the bank. E. Packing credit against hypothecation of goods. Export finance is made available on certain terms and conditions, where the exporter has pledgeable interest and goods are hypothecated to the bank as security with stipulated margin. In this case, borrower is required to submit periodical stock statement to bank. E. Packing credit against pledge of goods. Export finance is made available on certain terms and conditions, where the exportable finished goods are pledged to the bank with approved clearing agents who will ship goods from time to time as required by the exporter. The possession of the goods so pledged lies with the bank and kept under lock and key. 6. Post-shipment packing credit finance. Bank provides finance to exporters by purchasing export bills, drawn payable at site or by discounting USANS export bills covered by confirmed sales and backed by documents of the title of the goods such as bill of lading, air, ship consignment notes. It is necessary that exporter should obtain a shipment or contract risk policy of ECGC. Finance is also provided by banks to exporters by way of advance against bill forwarded through them for collection, considering creditworthiness of the party, nature of goods exported, USANS, etc. Commercial papers. Commercial paper, CP, is an unsecured promissory note issued as a debt instrument that enables highly rated corporate borrowers to raise funds for a short period. The maturity period may vary between 7 days to 365 days. The amount raised by CP is also large. The firm or the dealers in CP sell these to the short-term lenders, who use it as interest-earning investments of temporary surplus operating funds. The maturity term of CP is fixed. The CPs are issued with face value, but the issue price is less than face value. The difference is discount on the issue price work as a return to the lender at the time of maturity. Discount on CP depends upon the amount involved, maturity period and prime lending rate of commercial banks. The main advantage of CP is that the cost involved is lower than the prime lending rates. In addition to this cost, the borrower has to bear another cost in the form of stamp duty and placement fees, payable to the dealer of CP who arranged the sale. OCP comes under the purview of RBI, which has issued guidelines in 1990 on the basis of recommendations of the Vahal Committee. Guidelines for issue of CP in India. 1. CP should be in the form of usance promissory note negotiable by endorsement and delivery. It is issued at a discount to the face value as may be decided by issuing company. 2. Amount to be raised by CP is not restricted by the company's cash credit component of the maximum permissible bank finance. CPs can be issued up to 100% of the fund-based working capital limit enjoyed with the bankers. 3. CP is issued in the denomination of 500,000 rupees, but the minimum lot or investment is 2,500,000 rupees per investor. 4. CPs should be issued for a minimum period of 7 days and maximum of 12 months. No grace period is allowed for repayment. 5. CPs can be issued by a company whose A. tangible net worth is not less than 5 crore rupees. B. Fund-based working capital limit is not less than 4 crore rupees. C. Shares are listed on the stock exchange. D. Specified credit rating is obtained from CRISIL or ICAI or ICAI. The current ratio is 1.33. 1.006. All expenses, such as dealer's fees, rating agency fee, other relevant cost, should be borne by issuing company. 7. CPs can be issued to any person, bank, company. The issue of CP to NRLs can only be on non-repatriable basis and is not transferable. Benefits of commercial paper to the issuer. 1. Low interest expenses. 2. Access to short-term funding. 3. Flexibility and liquidity. 4. Investor recognition. 5. Ease and low cost of establishment to the investor. 1. Higher yield. 2. Portfolio diversification. 3. Flexibility to match cash flow requirements. 4. Liquidity. 5. Issued by reputed corporates, hence, less risky. 6. The instruments are credit rated. Intercorporate deposits, ICD. Sometimes the companies borrow funds for a short-term period, say up to 6 months, from other companies which have surplus liquidity for the time being. The ICD are generally unsecured and are arranged by a financer. The ICD are very common and popular in practice as these are not subject to legal hassles. Convenience is the basic virtue of this method of financing. The rate of interest on ICD varies depending upon the amount involved and time period. The entire working of ICD market is based upon the personal connection of the lenders, borrowers and financiers. Bridge finance. Normally to loans taken by a business, usually from commercial banks for a short period, pending disbursement of sanctioned term loan by financial institutions. Normally it requires a time for the financial institution to finalize procedures of creation of security, tie up participation with other institutions, etc., even though appraisal of the project is made. Once the loans are sanctioned in principle, in order to avoid delay in project implementation, bridge finance arrangement is made. Repayment. Such temporary finance is repaid out of the disbursement of the principal term loan. Security. It is secured by hypothecation of movable assets, personal guarantees and demand loans. Generally, the rate of interests on bridge finance is higher than as compared to that on term loans. Maturity period is equal to or less than 1 year, as per RBI guidelines. It can also be called as interim loan. Certificate of deposit, CD. CDs are time deposits of specific maturity similar in nature to commonly available fixed deposits, FDs, of the banks. The major difference between the two being that CDs are easily transferable from one party to another, whereas FDs are not transferable. The CDs are unsecured negotiable promissory notes issued by commercial banks and development financial institution, DFIs, while the commercial bank CDs are issued on discount to face value basis. The CDs issued by DFIs can be coupon bearing. The discount rates of CDs are market determined. The maturity period ranges from 91 days for the CDs issued by banks to 1 to 3 years for those issued by DFIs. CDs are freely transferable after 45 days after the date of issue. The CDs can be issued for a minimum amount of 1 lakh rupees to a single investor. There is no limit on total quantum of funds raised through CDs. Lease financing. To use an asset, by way of possession but not ownership. It is a contract between the owner of the asset, lessor, and the user, lessee, for a specified period. The lessor pays lease rentals to the lessor, at the specified time intervals, for using the asset. It is also preferred source of finance as it can be arranged faster than a loan from a financial institution. Types of leases. 1. Operating lease. Generally made for a smaller period and smaller rentals. The term of this type of lease is much lesser than the economic life of the asset, and hence the lessor is not said to earn to the extent of recovery of capital outlay. The risk incident of the asset belongs to the actual owner, and hence he will alone be eligible to claim for depreciation of the asset. Also, the cost of maintenance and repair is borne by the lessor, and such lease can be cancelled at the option of the lessor too. Finance lease is longer in term, and it can contribute for the recovery of capital outlay for the lessor. Thus, it is a contract to finance the use of the equipment for the major part of its economic life. The lessee is said to use the asset, but the title remains with the lessor. It is thus a capital lease, and is called a loan in disguise. The risk incident is transferred to the lessee, and he takes care of the maintenance and repairs. Even the reward of claiming depreciation on the asset is taken by the lessee. The lease is non-cancellable by either of the parties, unless with a prior notice as mentioned in the lease deed. Other types of leases. 1. Sale and lease back. The owner of the asset sells the asset to the buyer and makes a lease contract with the buyer for the asset, and takes the position of a lessee, making the buyer lessor. Thus, the asset is not physically exchanged and is left with the original owner only, i.e., seller or lessee. Thereby, the seller gets the sales proceeds and pays the lease rentals, and versa for the buyer. 2. Levered lease. The owner buys the asset by borrowing most of the purchase cost, say 80%, from a lender, and then gives it on lease to the lessee. The asset is given as security to the lender. Finally, the lender is paid off his dues from the lessee directly, and the surplus over and above the due is received by the lessor in the form of lease rental. Here, lessor can claim the depreciation. 3. Sales-aided lease. The lessor buys the asset from the manufacturer and enters into a tie-up with him to market the product. Asset. Lessor does the same with his leasing operations and receives both commission from the manufacturer and lease rentals from the lessee. 4. Open-ended and close-ended lease. In the case of open-ended lease, the lessee is given the option to purchase the asset at the end of lease period. Whereas, in the case of close-ended lease, the assets get transferred to the lessor only. In the latter case, the risk of obsolescence, residual value, etc., remain with the lessor. New debt instruments. It has become imperative for the corporate sector to devise new debt instruments for raising funds from the market. 1. Deep discount bonds, DDB. These bonds are issued at discount and redeemed at face value. They are issued for a very long period, say 20 to 25 years. No interest is paid during the life of the bond. The difference between the sale price, maturity, proceeds and cost of acquisition will be treated as capital gain, which is subject to indexation of cost and concessional rate of income tax. IDBI for the first time issued DDB at a deep discount price of 2,700 rupees, for which an investor got a bond with a face value of Rs. 1 lakh with a maturity period of 25 years. It allows investor to lock in the yield to maturity or withdrawing from the scheme on a specified period, after 5, 10, 15 or 20 years. The effective rate of interest to maturity works out to 15.54% p.a. The investor can also sell the bonds on stock exchange. One of the demerits of DDB is that they may face difficulty in arranging such huge amount of funds at the time of repayment. Face value equals issue price, 1 R, N, where R equals rate of interest per annum compounded annually, N equals maturity years. 2. 0 interest bonds, ZIB, 0 coupon bonds, ZCB. ZIB refers to those bonds which are sold at discount from their eventual maturity value and have 0 interest rate. These bonds are sold to the investor for discount. The difference between the face value of the certificate and acquisition cost is capital gain to the investors, which is subject to indexation of cost and concessional rate of income tax. The investors are not entitled to any interest and are entitled only repayment of principal sum on the maturity period. It operates in the same manner as deep discount bond, but the lock-in period is comparatively lesser. The investor prefers ZIB because of lower investment cost. ZIB may be fully or partly convertible bonds. Companies also find ZIB quite attractive because there is no immediate interest commitment. On maturity, the bonds can be converted into equity shares or non-convertible debentures depending upon the desired capital structure of a company. Face value equals issue price, 1 R, N, where R equals rate of interest per annum compounded annually, N equals maturity years. 3. Security premium notes, SPN. The SPN is a tradable instrument with detachable warrant, against which the holder gets right to apply for equity shares after a fixed period of time. The SPN have feature of medium to long-term notes. Example: Infotech Limited issue SPN, the face value of 1,000 rupees. No interest will accrue on the instrument during first 3 years after allotment. Subsequently, in year 4 to 7, SPN will be repaid in 4 equal installments of 250 rupees each, along with additional premium of 250 rupees each over 4 to 7 years. With each SPN, a warrant will be attached, which will give the holder the right to apply and get 20 equity shares of 10 rupees each at the end of 4 years at a premium of 20 rupees per share. 4. Option bonds. Cumulative. Interest is payable on maturity. Non-cumulative bonds. Interest is payable periodically. Redemption premium is also offered to attract investors. 5. Double option bonds. These bonds are issued in the form of 2 certificates, one for the principal amount and the other for the interest amount. Both these certificates can be traded in the stock market together or separately. IDBI issued double option bonds. The face value of each bond is 5,000 rupees. The bond carry interest at 15% p.a. compounded half yearly from the date of allotment. The bond has maturity period of 10 years. Each bond has two parts in the form of two separate certificates. One for principal of 5,000 rupees and the other for interest, including redemption premium, of 16,500 rupees. Both these certificates are listed on the stock exchange. The investor has the option of selling either one or both parts anytime he wishes. 6. Inflation-adjusted bonds, IAB. IAB are bonds which promise to repay both the principal and the interest adjusted with inflation. For example, if the normal coupon rate is 10% and inflation is 4%, the investor will earn 14% and hence value of money received will not decline due to inflation. 7. Floating rate bonds, adjustable interest bonds, variable rate bonds. The interest rate paid to the floating rate bondholders changes periodically depending upon the market rate of interest payable on gilt-edged securities. These bonds are also called adjustable interest bonds or variable rate bonds. If the issuing company expects that interest rate will decline in future, it will issue floating rate bonds. The interest rate may be linked to certain benchmark rates like LIBOR, MIBOR, Treasury bill rate, prime lending rate, etc. 8. Zero interest fully convertible debentures black small square. These are fully convertible debentures, which do not carry any interest. Black small square. The debentures are compulsorily and automatically converted after a specified period, and its holders are entitled to new equity shares of the company at the predetermined price. Black small square. The company is benefited since no interest is to be paid on it. The investor is benefited if the market price of the company's shares is very high since he tends to get equity shares of the company at an agreed lower rate. 9. Seed capital assistance. This is a scheme for providing financial assistance to deserving entrepreneurs who are professionally or technically qualified and possess the relevant skills and experience, but don't have adequate funds. This scheme promotes small and medium industries. A. Applicability. Designed by the IDBI for professionally or technically qualified entrepreneurs and/or persons possessing relevant experience, skills and entrepreneurial traits. All the projects eligible for financial assistance from IDBI directly or indirectly through refinance are eligible under the scheme. B. Amount of finance. The project cost should not exceed 2 crore rupees. The maximum assistance under the scheme will be a 50% of the required promoter's contribution or b. 15 lakh rupees, whichever is lower. C. Interest and charges. The assistance is initially interest-free but carries a service charge of 1% to 2% per annum for the first 5 years and at increasing rate thereafter. When the financial position and profitability is favorable, IDBI may charge interest at a suitable rate even during the currency of the loan. D. Repayment. The repayment schedule is fixed depending upon the repaying capacity of the unit with an initial moratorium of up to 5 years. E. Other agencies. For projects with a project cost exceeding 2 crore rupees, seed capital may be obtained from the Risk Capital and Technology Corporation Limited, RCTC, now known as ICAI Venture Capital Funds Limited, IVCF. For small projects costing up to 5 lakh rupees, assistance under the National Equity Fund of the SIDBI may be availed. Major sources of foreign currency funds. A. Commercial banks extend foreign currency loans. For international operations, just like rupee loans, domestic loans. The banks also provide facilities for overdraft. B. Developed banks offer long and medium-term loans including foreign currency loans. These are national-level agencies and offer several concessions to foreign companies to invest within their country and to finance exports from their countries, e.g. Exim Bank. C. International agencies, like the International Finance Corporation, IFC, the International Bank for Reconstruction and Development, IBRD, the Asian Development Bank, ADB, the International Monetary Fund, IMF, etc. provide indirect assistance for obtaining foreign currency. D. International capital markets. Savings of individual investors can be effectively tapped by issue of shares or debentures in the world market and not just in the local market. International capital markets in Tokyo, London, Luxembourg, New York cater to the needs of multinational corporations, raise substantial sums from investors spread across the globe, not just in one country. Sources of international financing. Euro issues. After decades of regulated economic policies, the government of India started major economic reforms in 1991 aimed at integration of Indian economy with global economies. In 1992, Government of India permitted Indian companies with consistent track record of good performance, for a minimum period of 3 years, to raise funds by issuance of equity, debt capital in international markets through Global Depository Receipt, GDR. Foreign currency convertible bonds, FCCB. Euro issues are outside the ambit of SEBI guidelines and regulations. Benefits to the issuer. 1. International market being very large and liquid has capacity to absorb larger issue. 2. Broaden the base of shareholders and quality of investors. 3. It offers better comparative share value. 4. Cost of raising funds from international market is generally lower than the cost of domestic issues. 5. It implies acceptance of sophisticated Western investors, which in turn will enhance the image of the company and product internationally. 6. Availability of foreign exchange fulfills the requirement of funds for overseas acquisitions and other capital expenditures. Benefits to the investor. 1. Euro issues are made by companies with proven track record. 2. Listed and traded in international stock market. 3. It is generally denominated in US dollars and hence minimize foreign exchange risk. 4. Dividend, interest and capital gains generally carry concessional tax rates. 5. Market for most of the scripts is liquid and hence facilitates faster entry and exit. 6. Investors are required to comply simplified formalities. 7. Diversification of funds. Financial instruments dealt with in the international market. 1. Foreign bonds. Debt instruments denominated in a currency which is foreign to the borrower and is sold in the country of that currency, e.g. a British firm places US dollar bond in USA. 2. Euro bonds. Debt instrument denominated in a currency outside the country of that currency. E.g. a sterling pound bond issued in Germany. A yen bond floated in Germany. A yen bond issued in France. 3. Fully hedged bonds. In foreign bond, the risk of currency fluctuation exists fully. Hedged bonds eliminates the risk by selling in forward market the entire stream of principal and interest payment. 4. Floating rate notes. In these notes interest rates are adjusted to reflect the Prevailing exchange rates. 5. Euro commercial papers. ECPs are short-term money market instruments. They are for maturities for less than a year. They are usually designated in US dollars. The principal distinguishing feature is that CPs are not underwritten by a bank and the issuer, therefore, is one with very high credentials. The paper is usually issued in higher denominations, of the order of $100,000, and the market is dominated by large professional investors. Although these can be issued in interest-bearing form, they are usually issued at a discount to face value and quoted in the secondary market on a yield basis. 6. Euro convertible bonds. It is a euro bond, a debt instrument which gives the bondholders an option to convert them into a predetermined number of equity shares of the company. Usually the price of the equity shares at the time of conversion will have a premium element. These bonds carry a fixed rate of interest. These bonds may include a call option, where the issuer company has the option of calling, buying the bonds for redemption prior to the maturity date, or a put option, which gives the holder the option to sell his bonds to the issuer company at a predetermined date and price. 7. Euro bonds with equity. Warrants. These bonds carry a coupon rate determined by market rates. The warrants are detachable. Pure bonds are traded at a discount. Fixed income funds management may like to invest for the purposes of regular income. 8. Euro convertible zero bonds. These bonds are structured as a convertible bond. No interest is payable on the bonds, but conversion of bonds takes place on maturity at a predetermined price. Usually there is a 5 years maturity period and they are treated as a deferred equity issue. 9. External commercial borrowings. ECB, to commercial loans, which may be in the form of bank loans, buyer's credit, supplier's credit, securitized instruments, e.g. floating rate notes or fixed rate bonds, availed from non-resident lenders, with minimum average maturity of 3 years. Borrowers can raise ECBs through internationally recognized sources like a. International bank, b. International capital markets, c. Multilateral financial institutions e.g. ADB, d. Export credit agencies, e. Suppliers of equipment, f. Foreign equity holders. ECBs can be accessed through a. Automatic route, for companies registered under the Companies Act, and NGOs engaged in microfinance activities, or approval route, i.e. after obtaining RBI, government approval. Method used to hedge against foreign exchange rate risk. 1. Foreign currency option is the right to buy or sell but not the obligation. A specified foreign currency at a specified price at some specified date in future. It provides hedge against foreign exchange fluctuation risk. 2. Foreign currency futures are rights as well as obligations to buy or sell a specified currency at a specified price at some specified date in future. It provides hedge against foreign exchange fluctuation risk. International financial instruments and Indian companies. 1. Foreign currency convertible bonds, FCCB. 2. Depository receipts, DR. American depository receipts and global depository receipts. Foreign currency convertible bonds, FCCB. The FCCB is a bond issued in accordance with the relevant scheme and subscribed by a non-resident in a foreign currency and convertible into equity shares of issuing company, either in whole or part, based on equity-related warrants attached to the debt instrument. FCCBs are unsecured, carry fixed rate of interest and option to convert into fixed number of equity shares of the issuer company. Interest rates are very low as compared to domestic market. FCCBs are denominated in freely convertible foreign currency. FCCBs are popular with issuers, as domestic market can be restricted with comparatively shorter maturities, with high rate of interest. On the other hand, low coupon, security option and arbitrage opportunities available with the investors is also an attractive feature. The major drawback is that issuing company cannot plan its capital structure, as it is not assured of conversion of FCCBs. Moreover, projection of cash outflow on maturities also cannot be made. FCCBs are also subject to foreign exchange risk. FCCBs result in creation of external debt that requires foreign exchange outflow from the country, if conversion option is not exercised by the investors. Advantages of FCCB: interest rates are very low as compared to domestic market. FCCBs carry a lesser restrictive covenant as compared to a debenture or loan. The convertible bond gives the investor the flexibility to convert the bond into equity at a price or redeem the bond at the end of a specified period, normally 3 years if the price of the share has not met his expectations. Companies prefer bonds as it leads to delayed dilution of equity and allows company to avoid any current dilution in earnings per share that a further issuance of equity would cause. FCCBs are easily marketable as investors enjoys option of conversion into equity if resulting to capital appreciation. Further investor is assured of a minimum fixed interest earnings. Disadvantages of FCCB: exchange risk is more in FCCBs as interest on bonds would be payable in foreign currency. Thus, companies with low debt-equity ratios, large forex earnings potential only opt for FCCBs. FCCBs mean creation of more debt and a forex outgo in terms of interest which is in foreign exchange. In the case of convertible bonds, the interest rate is low, say around 3 to 4%, but there is exchange risk on the interest payment as well as repayment if the bonds are not converted into equity shares. The only major advantage would be that where the company has a high rate of growth in earnings and the conversion takes place subsequently, the price at which shares can be issued can be higher than the current market price. Depository receipts. DR is an instrument in the form of depository receipt or certificate created by the overseas depository bank outside India and issued to the non-resident investors against the issue of equity shares. A depository receipt is a negotiable instrument evidencing a fixed number of equity shares of the issuing company generally denominated in US dollars. DRs are commonly used by those companies which sell their securities in international market and expand their shareholdings abroad. These securities are listed and traded in international stock exchanges. These are either American Depository Receipts, ADR, or Global Depository Receipts, GDR. ADRs are issued in case the funds are raised through retail market in United States. In case of GDRs, the invitation to participate in the issue cannot be extended to retail U.S. investors. While DRs denominated in freely convertible foreign exchange are issued by the depository in the international market, the underlying shares denominated in Indian rupees are issued in the domestic market by the issuing company are customized with local bank called custodian. An investor has an option to convert GDR into a fixed number of equity shares of issuer company after cooling period of 45 days. He can do so by advising the depository. The depositor, in turn, will instruct the custodian about cancellation of GDR and release the corresponding shares in favor of the non-resident investor, for being sold directly on behalf of the non-resident or being transferred in the books of account of the issuing company in the name of non-resident. Until such conversion, GDRs are traded on overseas stock exchange entitled for dividend but carry no voting rights. On conversion of GDRs into equity shares, the said shares carry voting rights and yield rupee dividend, and are tradable on Indian stock exchange like any other equity issue. The following agencies are involved in euro issue. 1. Lead manager. 2. Overseas Depository Bank. 3. Domestic Custodian Bank. American Depository Receipts, ADR, issued by a company in the United States of America is known as American Depository Receipt, ADR. Such receipts have to be issued in accordance with the provisions stipulated by the Securities and Exchange Commission, SEC, of USA. Such provisions cover many matters such as minimum requirements with respect to size, reporting requirements such as adherence to US GAAP, etc., and are stringent. Only very large companies in India can perhaps qualify for such parameters. An ADR is generally created by the deposit of the securities of a non-US company with a custodian bank in the issuer's country. The custodian bank ties up with the US depository for the issue of the ADRs. ADRs are denominated in dollars and are traded in the same way as other securities in the USA. Types of ADRs. A. Unsponsored ADRs. These are issued without any formal agreement between the issuing company and the depository, although the issuing company must consent to the creation of the ADR facility. With unsponsored ADRs, certain costs, including these associated with disbursement of dividends, are borne by the investor. For the issuing company, they are an inexpensive method of accessing the U.S. capital markets. They are exempt from most of the reporting requirements of Securities and Exchange Commission, SEC. B. Sponsored ADRs. These are created by a single depository which is appointed by the issuing company under rules provided in the deposit agreement. There are two types sponsored ADRs. I. Restricted ADRs. These are restricted with respect to the type of buyer, which is allowed, and are privately placed. E. Unrestricted ADRs. These are unrestricted with respect to buyer and are publicly placed and traded. There are three classes of unrestricted ADRs, each increasingly demanding in terms of reporting requirement to the SEC, but also increasingly attractive in terms of degree of visibility provided. Advantages to the issuer of ADRs: access to large capital, access to foreign exchange, no change in the shareholding, voting pattern. Disadvantages to the issuer of ADRs: high cost of issue and compliance. Disclosure requirements are more stringent. Global depository receipts, GDR. GDR is a dollar-denominated instrument tradable on stock exchange in Europe or the US or both. It represents a non-US company's publicly traded local currency, Indian rupee, equity shares. The modalities of issue of GDR can be put as follows. A. The GDR represents a certain number of equity shares. For instance, in case of Reliance Industries Limited, 1 GDR represents 2 equity shares. B. The GDR is quoted and traded in dollar terms, but the equity shares are denominated in rupees. C. The shares are issued by the issuing company to intermediary, called an quot, depository and quot. The equity shares are registered in the name of depository and he is the person who subsequently issues the GDR to the investors. D. The physical possession of the equity shares is with another intermediary called the an quot, custodian and quot, who is an agent of the depository. E. GDR has a distinct identity though it represents the issuing company's shares. In fact, GDR doesn't appear in the books of the issuing company. F. An investor has an option to convert GDR into a fixed number of equity shares of issuer company after cooling period of 45 days. He can do so by advising the depository. The depositor, in turn, will instruct the custodian about cancellation of GDR and release the corresponding shares in favor of the non-resident investor. For being sold directly on behalf of the non-resident or being transferred in the books of account of the issuing company in the name of non-resident. Once the underlying shares are issued, the same cannot be recustomized. Until such conversion, GDRs are traded on overseas stock exchange entitled for dividend but carry no voting rights. On conversion of GDRs into equity shares, the said shares carry voting rights and yield rupee dividend and are tradable on Indian stock exchange like any other equity issue. Advantage of GDRs: A. The issuer has the benefit of collecting the issue proceeds in foreign currency which may be utilized for meeting the foreign exchange component of the project cost, repayment of foreign currency, loan, etc. B. It has been perceived that a GDR issue has been able to fetch higher prices from international investors than those that a domestic public issue would have been able to extract from Indian investors. Circa GDR does not entitle the holder to any voting rights, so there is no fear of loss of management and control. D. The GDR holder can convert the GDR and become an equity shareholder instead. E. GDR does not involve any foreign exchange risk to the issuing company, as the shares represented by GDR are expressed in rupees. Differences between GDR and ADR: GDR quoted on stock exchange other than USA only. Institutional investors can participate in the offer. Limited institutional investors, so stock may not value at fair value. Low cost of compliance as compared to the ADR traded in more than one currency. ADR quoted in USA only. Disclosure requirements are less stringent. Disclosure requirements are more stringent. U.S. retail investors in addition to U.S. institutional investors can participate in the offer. Wider interest of the investors and better valuation of stocks on account of participation of retail investors. High cost of compliance as compared to the GDR traded in US dollar only. GDRs versus Euro bonds. 1. GDR is an equity instrument whereas Euro bonds are debt instrument. 2. GDR puts all the risks on the foreign investor, while Euro bonds tend to add to the country's external debt. Indian depository receipts. IDR is an instrument in the form of a depository receipt created by the Indian depository in India against the underlying equity shares of the issuing company. In an IDR, foreign companies would issue shares to an Indian depository. Say National Security Depository Limited, NSDL. which would in turn issue depository receipts to investors in India. The actual shares underlying the IDRs would be held by an overseas custodian, which shall authorize the Indian depository to issue the IDRs. The IDRs would have following features. 1. Overseas custodian. It is a foreign bank having branches in India and requires approval from Finance Ministry for acting as custodian, and Indian depository has to be registered with SEBI. 2. Approvals for issue of IDRs. IDR issue will require approval from SEBI and application can be made for this purpose 90 days before the issue opening date. 3. Listing. These IDRs would be listed on stock exchanges in India and would be freely transferable. Eligibility. Conditions for overseas companies to issue IDRs. Capital. The overseas company intending to issue IDRs should have paid up capital and free reserve of at least $100 million. Sales turnover. It should have an average turnover of $500 million during the last 3 years. Profits. Dividend. Such company should also have earned profits in the last 5 years and should have declared dividend of at least 10% each year during this period. Debt-equity ratio. The pre-issue debt-equity ratio of such company should not be more than 2 to 1. Extent of issue. The issue during a particular year should not exceed 15% of the paid-up capital plus free reserves. Redemption. IDRs would not be redeemable into underlying equity shares before 1 year from date of issue. Denomination. IDRs would be denominated in Indian rupees, irrespective of the denomination of underlying shares. Benefits. In addition to other avenues, IDR is an additional investment opportunity for Indian investors for overseas investment.